All right. What's up, everybody? We're here. Give me some. Vic. We're back. January OPEX already 2025. Had a couple weeks off after the holidays. Hope everyone is doing all right. I know there's a lot of you in the LA area, so thoughts are all with you, obviously. As we get started, Paul Inkles, nice to see you, man. All right, enough of my face. Let's get started. We got a real theme here today, and that is what I would describe as lack of volatility. And so as you can see here, S&P 500 had a nice bounce this morning, but that gave it all back, right? Gave it all back very quickly. And that's really been the theme. If you look at our founders' notes here, we had two things. Number one is we believe people are underpricing volatility. I put a chart kind of stating such on Twitter this morning. And then the second one is market rallies are subject to quick and violent reversals until we get back into this more or less positive gamma stance. And so when we look at the S&P 500 here, you can see big rally faded, but that's happened before, right? Big rally yesterday, faded. CPI comes in hot tomorrow. It is good night, especially when we break this 5,800 level. We see a lot of volatility down there. But to the upside, it's the same thing, right? There is no real resistance in our mind up into this 5,950 to 6,000 area. So those are 1, 2, 3% moves that could happen. We think really in the next week, and so I want to dig into those into those two concepts. Excuse me, particularly the volatility concept. So let's start with trace, and I want to show everyone the difference between the positive gamma and negative gamma environment that we have here today. I want to start with our gamma lens here. And we're zoomed all the way out. And what do you see above here? You see negative gamma above from really at the money all the way up to 5,900. And there's a small pocket of 0 DTE, kind of short dated gamma here, but then it's clearly negative above that all the way to 6,000. So for all intents and purposes, we have negative gamma above, which suggests that if the market starts to rally, there's fuel to help push that higher, which would give us greater than 1% moves. Currently, the VIX is at 19, which is pricing just over a 1% move at the moment. And then to the downside, it's the same thing. There's some short-dated positive gamma here, but below really 57.50, you see there's this big put position here, big put position at 57.20. Those positions would serve to really spool volatility higher. And I want to explain what I mean by that momentarily. So this is the lay of the land, right? We're waiting for CPI, negative gamma all around us suggests that we're in for a big move in either direction tomorrow. Now you got to remember too that tomorrow feeds into OPEX Friday, Martin Luther King on Monday, the inauguration as well, and then we feed in FOMC and then earnings season. So there's a lot of reasons for volatility to continue. The basis of all this is realized volatility. So let's just start with that. If we look at 1 month realized volatility, which is right here, we have a bunch of different volatility readings, but what I'm looking at is green, and hopefully you can read that there. 1 month realized vol is at 16. So if you just historically look back at what the difference is between VIX and 1 month realized volatility, it's about 3 to 4 points. So if you want to say, what is the baseline I should expect for the VIX? 19 to 20, right? And that's kind of in a normal environment. Again, VIX is currently right now at 19. So we're fairly valued, I would say, for the VIX given this amount of realized volatility. But that doesn't account for any of the triggers that we have coming up. Most of those are rate related. So if we go and look at volatility landscape, what we're going to see is we're going to see a term structure that's mildly elevated. As you can see here, this is the 90-day range, is this purple cone. We can see we're near the top of that range, but we're not all that elevated. And then with CPI tomorrow, there's a fairly high level of implied vol at about 26 due to CPI. That's fairly elevated, but that's certainly not bracing for any type of a material impact, especially given the rate situation. If we look at, just do a quick check on rates, the Wall Street Journal confused me this morning because it said the rates hit 5%, and then I looked and they were talking about the 30-year. So that was you got me there, Wall Street Journal. So you can see here, we are printing near highs, and a lot of people say, well, it doesn't matter, but it's the rate of change of these rates, obviously, that matter, and they've been moving up rather sharply. The hot CPI tomorrow may confuse things. And then, the fact is that Trump is going to start on Monday, right? And who knows what he's going to do with the tariffs. He may do nothing. I really have no idea. But there is that risk of a new regime starting, which is obviously a catalyst for more volatility. So there's a lot of impending changes that are really afoot, driven by this changing rate regime. If we look at skews, let me show you this chart here that we have. Jack Foran and I just recorded our OPEX podcast. That'll be out tomorrow, so we can really dig into this. But right here is 1 month implied volatility from today versus last week. And what do we see here? We see a mild shift higher, and it's a symmetric shift higher, right? There's not been you would expect a rise in the relative downside puts. So you would expect maybe the wing to steepen a little bit with some of the volatility we've had recently. That has not been the case. The other thing too is if we start to look at some of the other metrics that we see here, where is it? I was looking for my VVIX chart. I could just show it up on here. VVIX elevated, but it's not at a spot that is, absurd. If you look at this here, we're in the 112 level in the VIX, which measures it's the volatility or the VIX of the VIX. So sort of how high is the vol for, let's say, out of the money VIX calls. And what you'll notice here is that, at 110, 112 area, it's poised for a spike, but it's not actually spiked, right? It's just elevated. It's kind of at the ready stance. And the way that I describe this is significant, as well as, when we look at the VIX at 19, is when we have a real risk-off scenario, kind of a tail risk move like we had in August, and arguably briefly had after the Fed in middle of December, is, we don't get a VIX jump from 10 to 20 direct, or 10 to 40 directly. We don't get that huge move, right? You usually get the simmering of VIX and vol to VIX goes to 20-ish like it is right now, and then it sits there and staged. And this is the point where you can really get that jump. And so when you look at that negative gamma regime that we have, and you look at the VVIX here suggesting that, we're simmering, we're not overbought in volatility space yet. But if we get a negative CPI or some other little negative trigger, we could have a real nasty 1.5% to 2% drawdown, I think, very quickly in the S&P. And that would lead to a really convex spike in vol. And I'm focusing more on the downside here, not because I know that there's any type of a tail coming. It's just the upside to me seems very obvious. Cool CPI print. Bam, we're at 59.50 to 6,000 in the Friday OPEX. That's a bigger move than most people would expect to the upside, but that would be sort of path least resistance, kind of no problem. Then we'd have to see what Powell and Trump come up with next week. But this downside, I think, is the thing that people maybe aren't pricing, just because we haven't really seen that huge risk off, right? If you look at what the correlation of the VIX has been over recent days and weeks, what you see here is obviously this is a pretty linear correlation, as you can see here. And our recent prints are showing that, could you argue that the VIX move has been relatively muted, or vol's been a little bit muted relative to the S&P drawdown? It's not standout. But what does catch my eye on this chart is that when you start to have more than those 1.5% downside moves, right, that's where you start to get the convexity in vol, right? I think that's where you start to get the jumps in volatility as we're signaling with the VIX right here, right? And I think we're staged at that area. There's a lot of times where we're looking at positive gaming in the market, or no real news are on the horizon. There's no significant trigger where you go, look, the risk of having this jump risk is not that large or not that high. But in this regime, I think that jump risk is quite high. And so, that is kind of the point that I'm really trying to drive here with everything that we're seeing in the data. And I would just suggest too, if you look at the cost of put protection, and this is not an advertisement saying, hey, everybody, you got to go all in on put positions here. It just doesn't strike me as that high. I know this chart's a little tough to read. This is from Bloomberg, but this is 1 month S&P 500 put implied vol for 25 delta puts. And the mark is right here, right? And if you look back all the way to 2020, that's a relatively low implied vol for this put. And this is after we've come down 5% from market highs only about a month ago. So there is not a real respect, I would argue, for any type of event vol premium in the space. People are not pricing in a significant shift higher in volatility, and I think that could pose to be a problem, particularly if the CPI data tomorrow, or if there's Trump tariff talk that picks up, anything like that, then you could really see, I think, a fairly significant move lower. This is not only my view. I'd written this presentation, and basically what I do is I look at, 100 different data points, and I just see kind of what jumps out. And it's this underpricing of vol, which seems to really jump out at me. Interestingly, yesterday the CBOE put out this piece, and they had two real notes on this. Number one, they said TLT, which is the long bond ETF, the skew there is very muted. I'll show that in a second. But the other one was this. This is comparing implied volatility minus realized vol for SPX. You can see it's a negative, which tells us that the implied vol is actually trading lower. Forward implied vol is lower than realized in the S&P, and the same thing in the NASDAQ and the Qs. That is not true in the Russell complex, but here, you can see that realized vol, and this is 1 month realized vol is a little bit lower. Now, is this a zero DTE effect? Because we don't have to hedge longer dated options because we could just buy, the zero DTE options, which are, 55% of S&P possibly. So maybe this is just something that's going to be kind of standard issue from now on, that longer dated vol doesn't care until vol's kind of like jumped. And then you see more focus on longer dated positions. I'd be open to that idea. But, fact of the matter is that right now it seems to be a little bit laggy in my view. This is the chart on the TLT. As you can see here, this is skew for TLT, 3 month skew. And you can see compared to relative drawdowns of 9% in a month, which is what the TLT has had, the skew here is very muted. So there's not hedging arguably in the TLT, which is the long bond ETF either. So really quite interesting that vol writ large seems laggy. Now, is the focus on interest rates warranted? If you look at this here, this is correlation across major assets, primarily equity assets. So you have IWM, Qs, Dow, et cetera. We have IBIT, which is Bitcoin, TLT, the long bond. Then I have Tesla and SMH as proxies for, Mag 7s. And what you see here is correlation for the first time, really in about a year, maybe year and a half. Correlation across assets is really in sync. Over the summer, we talked a lot about correlation where we'd have NASDAQ or semis or, whatever it is that was breaking rank. And this tied into negative breadth and particularly with NVIDIA, right? And then it was after the election, it was Tesla that was the standout, the kind of odd man in terms of how fast it was accelerating. Well, everything right now is really in sync. And that to me is just saying that there is really this focus on rates. And that is, what highlights the importance of CPI. I think a lot of times there is, a focus on CPI or whatever the next data point is, doesn't really matter. And, I do think in this case, tomorrow's CPI could really invoke some vol. And everything does seem so based on this, right? Vol is low in bonds. Vol seems low in equities. Correlation is very high, which suggests that if there is a pop, then a pop in the inflation data, then the market could drop and we're going to see kind of vol lift across all assets. I want to talk about this idea of so the other thing that to me is different about this regime is that in all of 2024, we had largely NVIDIA, right? NVIDIA led the market. Mega caps led the market. That died out a little bit in August. And then when you get into really November, we had the Trump trade, right? And crypto and Tesla and Palantir and some of those names really led us. And that bubble really seems to have popped. And that brings up two interesting things. Those of you who are SpotGamma members, remember in our Q&A last Tuesday, we were talking about how bizarre the NVIDIA, or Monday, excuse me, we were talking about how bizarre the move in NVIDIA was. And we saw just this massive, what looked like humongous call selling at the 150 level in NVIDIA. And in fact, that was right here. You can see that rally. NVIDIA was up 10% to start 2025 in the first week. It hit 150 into CES, and then the next day it absolutely puked and has been unable to catch a bid since. What I find interesting about that is this is the net call volumes. So it took call volumes minus put volumes over the last year for the top 25 names of the NASDAQ. And you can see there are these odd spikes in net call volume that seem to correlate with blow-off tops in a lot of ways, particularly in July at least. And so you could see that this was the start of year spike that we saw into Monday, which was when there was this bizarre, SMH breakout. And it looked like, okay, who cares about rates? Like we're off to the races. And all of that puked and all that gave back. And so what we see here is some real options-induced, vol of vol. And what's interesting to me about this is Jensen Huang comes out and he absolutely kneecapped the quantum computing space, which was like the last of the memes. We also saw, I believe, some data saying that people are maybe pulling back some orders and things like that from NVIDIA. And so I call this the quantum computing. My buddy Jack was pretty happy about that. So I'm calling this the quantum compute. And what you see here is call volumes in the quantum computing space. They went from, in the sector, I think there's about 5 or 6 names. They went from about 2 million contracts all the way up to 6 million. 200,000 all the way up to 600,000 in daily volume into the end of the year. And then suddenly, just like that, with one comment from the NVIDIA CEO, it's done, right? Totally faded. The rallies are done. That bubble popped. And it just strikes me as that is so fleeting, and it is really the last of the memes, the last of the chases. And that really has been so descriptive of what's been happening this year is the chase, right? We were chasing all these different assets. And right now, what do you chase? I got one name and one name only that I think it looks chasey to me, and it's an oldie, the typical Tesla trade. But other than that, you say, well, what is going to kind of lead us higher? What is the sector that's really going to move? I don't have the obvious one, right? If they not announce the Bitcoin reserve, then we start to rally in that space, and I don't know, maybe okay. But the quantum computer thing is dead. Is the AI trade dead? I don't know. But what it highlights is the fact that we need to clear up the rate regime, which is going to happen probably in the next 2 weeks. At least we'll have some better information on that. And then we're going to go right into earnings. Earnings are starting this week, obviously. And so when we start earnings, I think we'll start to see if there's going to be that next kind of chasey bubble move. I wanted to highlight this from earnings on the topic of volatility. Normally what happens, this is data that just came out from Nomura, normally what happens into an earnings season is volatility, realized vol in the S&P contracts. So right now we're at 1 month realized vol is 16 for the S&P that forecasts about 1% daily moves. And what NVIDIA's data says is into earnings season, S&P vol tends to contract. Now you just say, well, is that because focus on the single stock side and that shifts correlations? And okay, fine. But that is what the data says. Now, the time that is different is into January earnings seasons, where their data suggests that volatility, realized vol, tends to expand around earnings seasons. Now, there's been some really big January, early February type moves over the years. I mean, that's when we had Volmageddon in 2022. There was huge moves, obviously. So, the point here is that there's a lot of reasons with the triggers over the next couple of weeks with the negative gamma regime. Now, when you look at this data here, that suggests that there's support for the amount of volatility that we're having, right? So realized vol should remain elevated, which suggests to me that implied vol, again, which is trading at a discount to realize, that doesn't seem to all sync up, right? So there again, there's this real theme that that keeps popping up. I have not looked at Core 1N recently, so let's just take a quick look as Paul brings that up. Correlation, obviously. What generally tends to happen with correlation is when stocks crash, all stocks crash, and that means correlation goes up. So you can see that's what happened in August, for example. And the story in most of 2024, and particularly when we hit right before the big August crash, right, was correlation hitting all-time lows. And, look, when you get these types of very strange moves. I mean, we spent most of June and July. We had a presentation about the number of weird data anomalies, record low days without a 2% move, lows in realized vol, correlation breaking. I mean, I think we had 15 different things we've never seen before, or it might have been more like 10 different things we've never seen before, lining up at this time frame. When you get this stretched, oddities in the data, that usually unwinds violently the other way. So the point is that do you get this spike in correlation without having correlation go to almost, this correlation metric almost go to zero, right? You need it to get stretched one side, to have the rubber band kind of get flung to the other side. And so again, correlation, kind of like when we're looking at vol or the VVIX chart, you're sitting here looking, this could easily, with a bad CPI number, spike, right? Which would again sync with all these different declines in data. So, which would sync with the negative gamma and simmering volatility, et cetera. So, this is, again, I think a real pivotal point. We need that trigger. I don't think this just spills over, for no reason. But if you get that hot data point, then maybe that is the trigger to get vol really moving. I had another quick data point to show here, and then I will scroll through and make sure I'm getting to the questions. OPEX. Let's talk about OPEX. Fancy new chart that we got here. I spent a lot of time trying to get this thing together. Friday is OPEX, and so I have two big names that we're going to look at for January options expiration. The reason that we have a hard time forecasting, what the index impact will be is because we need to see which way the market goes off of S&P, off of CPI, excuse me. I think if we rally up in that 5950 to 6,000 area, then maybe we sell off after OPEX, that mean reversion trade. Obviously, if we have a big vol spike into OPEX, then maybe we get some relief after. So that performance turnaround options expiration. But the total size in the S&P 500, this is delta notional, you could see that the S&P 500 is as big as the rest of the U.S. options complex combined. But this is quite a bit lower than what we saw in December for the S&P side. But on the single stock side, this is about 3 or 4 times bigger than what we saw in December. January is always very, very big for January expiration. It's because lately we've had big year-end rallies, right? And big rallies over the year, and that builds up these January leap call positions. This year is no different. You could see that there's big calls expiring on the single stock space. And so, I do think that if we do start to sell off, that this can exacerbate volatility, because I think a lot of these calls are long calls. I felt this way last year that this could induce volatility, and that didn't happen. So, I'm kind of 1 for 2 on this, because in 2022 we certainly had a ton of volatility in January. The other thing that is interesting, putting this all into relative context, is this is the size of the Russell and NASDAQ complex combined, right? So it is really a flea on the kind of elephant's rear end, so to speak. We love the NASDAQ. We do a lot of stuff with them, but they have some work to do in terms of getting their deltas up. And so I think a lot of times people are analyzing with gamma data, and they're looking at, the impact of the Qs. That complex is just quite a bit smaller. Whereas in the S&P, we always have a massive complex, and I think there's a lot more options control that is evident in that flow. So that's an important thing to distinguish. And then last but not least, and then I'll turn over to handle some questions, 2 names that we really want to look at into expiration. And I thought this was interesting because it gives us some real comparative data, right? For those of you who don't know, this is data from our equity hub, and our equity hub is showing us gamma by strike. Now, before I get into this, if you are interested in downloading an OPEX spreadsheet that details how big call and put positions are for this expiration, go to spotgamma.com/OPEX, and then you just pop your email in and you get our OPEX data. You get also alerts when we're doing Q&As, different things like that. So spotgamma.com/OPEX for that. But back to the presentation here. This is data from the Equity Hub. And what you see here in Tesla is this is a massive 400 strike. It is giant. And for those of you who may be new here, I wrote a piece after options expiration talking about how I thought people were really underpricing Tesla volatility. So people bet that if Trump would win, Tesla would go up, but they did not, in my view, appropriately price how fast and how large Tesla could go up. So we nailed that call. I then came out with another piece in December saying, hey, I think Tesla 420 may be an interim high. What Tesla proceeded to do, I made that call here, is it spiked to 480 just to make me look like a jerk. And then we came back, and now we're back under this 400 level. So what I see here now is a ton of positions building up at higher strikes for Tesla, particularly in this 450 to 500 area. 50% of the gamma at 400 is set to expire on Friday for Tesla. So this is a very big expiration for Tesla. And we have some new data that we've been compiling, and I want to just give you all a little bit of information. So I look at this data quite often. What you're looking at here is from our positional database. This shows you signed GEX. So what do we track whether we think people are long, dealers are long, puts and calls and the impact. So this is the current GEX for Tesla, the black line. And you can see it's moderately negative gamma position for Tesla around this 400 area. And interestingly, if you look at the Tesla chart, it's been pretty sticky at 400 over this time frame, where certainly this year the stock is even up a little bit. That's in the face of the S&P 500 being down 5%, right? So there's clearly some kind of a pin around this 400 mark. But look what happens after expiration. You can see that we're going to lose that pin, right? This is all of that at the money gamma, and the gamma goes from fairly positive to much more negative with expiration. What this infers to me is that the volatility of Tesla should now pick up. If the CPI is hot, then and we go down, then there's plenty of negative gamma, I think, to finally drive Tesla quite a bit lower down into this 350 area. But conversely, if the market starts to rally, then I think this 450 area becomes into view pretty quickly. So what I'm saying is we seem coiled for a pretty decent 10% move in Tesla in a fairly short amount of time. And so, those of you who are looking for me to say something, I think that's saying something. That's pretty elevated volatility. And so if we see CPI and we see the market lean one way or the other, then I would be looking to lean into Tesla as a relative performance, to have larger relative performance than the market. And I understand that Tesla always generally moves more than the market. Not always, as we've just seen, but you're going to see, I think, a lot more volatility. And Paul asked the question, your negative gamma is long calls on the customer side. That is right. Customers are long Tesla calls or possibly long puts. It's a mixture here in this GEX chart. And so in this case, dealers are short these positions, which adds to the negative gamma. Now let's compare that to NVIDIA. NVIDIA, if you remember, had that really nasty reversal, right? Just a week ago, and you can see the relative volatility in NVIDIA, right? You can see here, huge 10% move, 10% move up, 10% move down. Now in this case, we have huge positions at 140, but even at 130, 120, this is billions of dollars of gamma in terms of the put positions. And what's so interesting about this now is that the position has come down quite a bit. The downside is run out of steam. And when we look at the relative position now in NVIDIA, what we see is a huge positive gamma position from 140, arguably kind of down into this 130 area that is now built up. So what I read from this is that calls were sold into that big rally. There appears to be a long call, short put complex on in NVIDIA right now after these big moves. And so we have a big positive gamma complex. Now, what's going to happen in NVIDIA, it looks like, is that positive gamma complex, well, a lot of that is around this 130 to 140 area, is really set to dissipate. Now, the reason that I bring this up is because it suggests that there's still negative gamma to the upside into 140 in a Tesla, a mild negative gamma. But what catches my eye more is that to the downside here, particularly on 120, there's no gamma, there's no positioning down there. And so in that situation, if I'm long NVIDIA already, I'm not as worried about downside as if I was long Tesla, and I think there could be a lot more relative downside there, right? So the 120 area just strikes me as an area which NVIDIA may really find some support or just lack of downside selling, which may make sense if they are still kind of the leading purveyor of semiconductors and the like. So those two relative curves are really quite interesting. I think that this data will really help us kind of track into next OPEX. We can all say, hey, Brent, you were the champion for picking all these ideas out. Or, you got somewhere I have my clown horn over there that says you got these very wrong. So it'd be quite interesting to watch those relative moves. Again, if you're looking for more of this data, we don't have the proprietary GEX data in there yet, but if you're looking for these position skew metrics, IV metrics, etc., you can go to spotgamma.com/OPEX and download that sheet. Brett Romero, what's up? S&P got above 58.38. Why didn't Vanna? I don't know what a Vanna cross is. Why didn't Vanna keep pushing it higher? Okay, so let's talk about why we didn't get a quote-unquote Vanna rally. It is because we have the main element. I don't mean to be a jerk, Brett. I have no idea what a Vanna cross is. Why didn't we have a volatility release today? It is because even though PPI was out today, that is not the main event, right? CPI is the main event, as you can see here. So we can't have volatility release until the event is out of the way. And so, even though implied vol I think is a little bit low, we know we have this huge date coming up, which huge data point. If this data point is benign and it eases rate expectations a little bit, we're going to feed into the 3-day weekend and a big options expiration. And so at that point, you may see a bunch of vol contraction and decay pick up, and then I think we could see a real relative rally. This is kind of like if you've ever traded an option on an FOMC day and the decay of the option, like if you take a 0DT option, the decay of the option, it won't decay at all, even till the FOMC event, right? Even though we go through 3/4 of the day, right? The option doesn't decay at all. And then as soon as the Powell speaks, then all of a sudden the options values will change a bunch. And so I think that's kind of true. Brett is saying, look at the Vanna chart I showed in the founder's letter. Let's take a look. I don't know. I don't see that in here. We do have a Vanna model in our index page. So let's take a quick look and see about that. So there's nothing here, right, that would necessarily mean that a trade should happen if this is, like, suppose what you're referring to, Brett. What this model is showing us is that this is an estimate of dealer positioning, and this is just a naive GEX model behind this, meaning we assume dealers are long puts and short calls in this model. And what this is meant to depict is what is the impact of implied vol. So if the market goes down, vol should go up, and that means that dealers have a lot more to sell if the market goes down. Conversely, if the market starts to rally, they have a lot more to buy. And so what this is estimating, this curve is telling us that volatility is inducing market movement, right? There is times where this curve, the purple line, will go up instead of going down. And when it goes up, what it's suggesting is, and this is because we have a lot of call positions in place, that when vol collapses, dealers are long calls, and so that will contract those positions if the market goes up and leads to Vanna actually working against the market, right? Stuffing market volatility. And so that is really a difference. There's nothing significant about the cross of these 2 points. This is just the pivot point based on what the kind of at the money option is. So that's a good question, Brett. I'm glad you asked it. Vol really can't release right now due to the CPI for tomorrow. Kramer asked, what are the chances that we go down tomorrow after CPI since the event vol is so high? I don't know. Yes, Eric, it was in the Friday PM note. Sorry, buddy. I don't know. I don't know in terms of CPI. I don't know what a hot number is. I don't know what a reaction to the number is. I don't know how the rates are supposed to shift all that. I don't really have a view of that. What I'll simply say is this, the market right now is kind of rallying back. If we break 5,800, that is my signal to want to start shorting and making sure I'm long vol in some format. VIX calls, probably put spreads because vol is a little bit elevated. That is the risk off signal, and that's likely what I'll be looking for. We could still see a substantial rally this afternoon just off of directional flows, and so we may have to adjust that a little bit. But for right now, assuming we close in and around this area, it is that 5,800 number, which is the real, want to make sure at that area that I have that short exposure on. And then to play the upside, I'm just long some Friday calls, and that's how I just wanted to hedge out, that risk. I think you could structure some call flies or something like that, but my plan is to own some calls. They're around an 18% implied vol for Friday, and if we do get a move higher in the CPI, then I'll turn those into a call spread or a call fly. I'll try to monetize those. But I wanted to just isolate that risk to the upside. Say, okay, great. I think we can move up more than the market expects. And so I opted to buy some January 59.50 area calls. And then to the downside, if we do break that 5,800, I'm going to make sure I have some short exposure. And sometimes in this environment, I'll just go short stock or short futures because I don't want to necessarily pay up an implied vol if I'm not, if I'm not wanting to deal with. So you just, Delta one, someone will call it, but you don't always have to buy the option to express some downside there. Yeah, and the there you can get more advanced in models in a lot of ways, and in the relative support or strength of this market. Sometimes these tried and true models just work out really well. What you can see here is if the combo strikes, what they're showing you is we net out put and call gamma for the S&P 500, that's SPX and SPY. And you see just a real clear transition here, right? This is telling us that puts are dominant down here. Whether this is long puts or short puts, that generally invokes a lot more volatility when we are in a put regime, and that's what we're in as long as we're under, for sure, 5,900. But as I mentioned with Trace, we're seeing big put positions at 5,700, which could really spool volatility in my view. And then to the upside, you see once we get over 5,950, it's a lot of call positions, and you go, look, this is just really simple. If we're in calls and people we know we're selling calls up in that area, we'll get the volatility kind of crush into the market holiday, and then things are likely to get quiet around the inauguration and waiting for Powell and stuff, and we think vol would really start to contract in here with long calls, and you can see these call positions pick up, right? So here you want to play for big directional moves. Here you want to pay for a crushing of volatility, and so that's just the general lay of the land here, right? I tend to carry long spider positions always in my portfolio, and the question is, am I selling calls against those? Am I trying to hedge those downside risk? How aggressive am I getting? And so, to put this in a more simple term, I have downside hedges on for right now in case we fall lower. I'm short dated calls in the 59. I'm long some 59.50 area calls in case the market does jump up quite a bit. I want to make sure I catch that relative upside, particularly because I know I have these put hedges on that are protecting the spider equity in my portfolio, right? And the put positions are put spreads or put flies, depending on what tenor you're looking at. So I always try to carry some downside protection there. If we get up into this area of 600, then I'll be much more aggressively selling calls against my spider holdings with the idea that volatility is going to contract. But I don't want to limit my upside in this scenario in case we get good news and the market really starts to jump. Kenny T says long straddle and tomorrow is a play here. I'm not gonna offer specific investment advice on this stuff. I don't know that I would go with the straddle today, Kenny. I would maybe wait to see what the straddle price is kind of right before the event, right? And the reason is because if we put the straddle on now and the market moves 20, 30, 40 points between now and tomorrow morning, which it easily could, then you're not so neutral anymore, right? So let's just take a quick look at the straddle. If we're assuming we should get a 1% move between now and, between the CPI print and the end of the day, that makes a lot of sense. Right now, the straddle is priced at $63. Obviously, we still have half the session left today. So, in a 23% implied vol, we have in the founder's note this morning, I marked the 0 DTE straddle, and I didn't write the. I did write the vol 26%. So. Currently, obviously, this implied vol is going to change a little bit between now and tomorrow, but it seems like pretty much we're probably going to end up maybe in line, maybe a little bit richer, I guess, than today. The straddle trading a little bit higher, but I think if that straddle price is 100 bips or less, then I would edge on it. Being long is the interesting way to go. But the other way to play this is to maybe buy like a Friday straddle or if we do break under 5,800 and we think vol is going to spike, well, let's wait and see. Let's see if futures start to move under 5,800, then we'll short the market, right? So there's a couple of different ways to play it. I think you can play the reaction. You don't necessarily have to be positioned ahead of it. You can wait to see which way the futures look like they're going to break, and then kind of jump on board after that, if that makes sense. Yeah, Dan B says over time, would you have made more money not hedging and just leaving the long SPX position? I mean, S&P is at almost record highs, right? So any backtest you ever do shows that just owning spiders is the best decision. And that's easy to say right now when we're just a few percent off all-time highs. But in January, in mid-2022, your backtest would show that hedging actually makes a ton of sense. And then not only that, it depends on how you hedge. So, my general view is that the S&P is going to go up over time. U.S. equity market's going to go up over time because of inflation and passive inflows and yada, yada, yada. And so, you want to have that upside exposure. And my hope is that I can hedge out some of the downside risks, offset those costs, along the way. And I also like owning those spiders so that I know I got that upside covered, right? There's a terrible feeling in the equity market running away from you, and you just don't own anything. So I think I can generally hedge out the downside, at least the sleep at night downside. And we talk about a lot of that in the founders notes. If I say, hey, I think puts are cheap here, then that generally means I'm trying to buy puts to hedge out some of my positions. And I would say, I'll be watching Tesla. If the CPI is bullish, equity bullish, then will I look to get into some Tesla positions? Then on that note, then the same thing, right? Generally, I'm not going to talk about moves that I wouldn't be willing to express. Kramer's back saying Kim just called for a 10% decline by March. Any thoughts on how positioning is that would enable that? I don't know why he's calling for a 10% decline by March. I don't know. Here's what I would say. In January of 2022, we had a 12% drawdown, and it was really a very violent drawdown, right? And the setup to me seems very similar. You can see I highlighted that drawdown right here, right? 12%. And it was, and I know I have an absurd number of lines on this chart, so those of you who are yelling about that, I hear you. But the timing is so interesting, right? We hit the all-time high rate first day of the year, right? And remember, Powell said, hey, we're going to raise rates probably, right, in December FOMC, and the market still went higher. And I think everyone's like, what? And then all of a sudden, all that came to roost in as December started. And we just dropped like a rock, and into OPEX, and then the low was made between OPEX and FOMC, and then we got that kind of rally off of FOMC. We don't have to follow this same path. But what is interesting to me about it is we talk about those really big OPEX call positions. Could those drive volatility? Yes. Could the fact that the market is underpricing volatility be a risk? Yes, absolutely. I think that could drive like a jump in volatility. If people go, oh, we're pricing in less than 1% move and realize vol's like 1.5%. Well, we got to get out, we're off on this, right? We're mispriced. Kramer says in 22 wasn't the Ukraine-Russian war the catalyst? I don't think it was. That didn't happen until we didn't get big VIX. We didn't get that VIX move here, right? So I guess if I look at there's your Jan move was more like 8%, right? And then the full move down to March was 12% drawdown. So an extra 12% seems like a lot. I really don't know. I think that if there's path dependency, right? If we puke now into FOMC, then maybe we rally after. We don't see that low. If CPI is hot and Powell's hawkish, then sure, that makes sense. But the idea that we could easily sell off even 3% more into Friday, to me, that totally makes sense. If the data triggers the kind of volatility bid, which I think is what the risk is. Right now S&P is just like absolutely ripping, right? If we check out Trace, you can see quite a move here. And I think in this situation, you end up with people wanting to pull forward this move, right? Saying, hey, we're rallying now because of some macro, people are pre-reading CPR or something. I don't think it has anything to do with that. These are just negative gamma flows, and we're really just swinging. We're really just swinging around quite a bit. And another reason why I don't want to put on your CPI straddle earlier, because there we go, we just moved on our 20 handles. Yeah. All right. Looks like I caught up on all those questions. We got to wrap it up there as we have a big presentation with our friends at Wealth Charts. If you're interested in that presentation, believe we put out a couple emails about it. If you join the SpotGamma.com/OPEX, if you join this, you can just respond to that email, and we can shoot you the Wealth Charts presentation that we're about to do. So Thank you all very much for joining us today. That is going to wrap it up a little bit early because, again, we have another presentation we have to jump to. We will be back, I think on Monday, actually, is our next subscriber Q&A. So if you sign up for a SpotGamma membership, you can join us on that Q&A on Monday. Obviously, the market should be quite a bit different from where we are sit today. Again, go to spotgamma.com/OPEX if you want to get the OPEX spreadsheet. Hopefully you check out the Tesla and NVIDIA recommendations. If you want some more of this, we did a very measured presentation with our buddy Jack forehand at the Excess Return podcast. He's going to drop that tomorrow. So we will be able to do that. And all right, that wraps it up for me. Thanks again, everyone, for watching us, and beware of the volatility. All right, take care.